Hi, welcome to today's video titled The 7 Biggest Mistakes Consumers Make When Buying an Annuity and How You Can Avoid Them. My name is Scott Brooks and I'll be your host for today's video. I've worked in the industry since 1998. Throughout my career, I've also trained over 7,500 financial advisors in the 401k rollover market. And I've had, for another part of our business, I've actually worked with over 3,000 financial advisors and insurance agents for our referral service that we have in the annuity space. I've worked in the industry for quite a while, and the goal of today's video is really to help you save time and prevent from making a decision that's difficult to undo. A few years ago, I coined a term which was annuity hell, which to me, that's being like 3 years into a 10 or 20-year annuity contract and realizing you didn't realize what you purchased, and just then figuring out that you're stuck in this annuity for another 7+ years. So the goal of today's video is actually to give you information that you need to make a better decision. The first mistake that I've seen people make is not understanding the renewal rates for index annuities. Now, this is the number one risk that you face if you buy an index annuity, and it's something that many people just do not understand. Companies that sell index annuities are probably not going to talk to you about this on the front end. Basically, when you buy an indexed annuity, there's a formula in the contract that determines how much interest is credited every year or two for your contract. And this is for 98% of the index annuities in the market. This formula, what's important is the company can change the formula every single year or two. And what they do, there's a big difference between the caps that are set and the caps that are set when the product is sold and what they actually renew at. So understanding this is very important, because before you buy the annuity, you need to be able to identify this in the contract itself. The reason this is important is that if you buy a 10-year index annuity, you could get, they might offer you a nice crediting rate in the first year, but if it's a 10-year contract and it renews every year, the renewal rate history of the company will be very important. This index can actually go up, but if the company wants to, they can actually give you very poor renewal rates, and you'll be stuck earning 1% possibly in the annuity. Understanding the renewal rates and the history of the company is very important. The other thing that's important is if you're getting a fancy proposal, there are several services in the annuity industry today where they show you that you're going to earn 7 or 8% in this proposal that's back tested. The proposal services do not factor in the renewal rate history. So it's really misleading, in my opinion, because you can be looking at a proposal that might have done 7 or 8% in the past, but if it doesn't factor in this renewal rate history and the company can change the formula every 1 or 2 years, you're not likely to get anything near what you were promised or what the proposal was before you purchased the product. This is something that's very important. Now, the question is, where do you find this in the contracts? Now, before you buy the annuity, you can request what's called a specimen contract, which has the details of the contract of the index annuity before you buy them. And you can request the specimen contract for any type of annuity, for an income annuity, for a MYGA, for an index annuity, or a variable annuity. Basically, what this allows you to do is look at the fine print on the contract before you sign the dotted line, because if you're doing a transfer from one firm to another, it's much better to be aware of these problems before you transfer your money from one institution to another and then have to go through, if you hate the contract and have to undo this and you send the money back, it's a mess, right? So, but in the specimen contract, I want to highlight, and these are the areas that are covered for 3 different A+ rated carriers. What you'll notice here in the top left, you'll notice the minimum participation rate was 100% year 1. The minimum cap after that was 0.25%. So there's a big difference between 100% and 0.25%. So literally you could get renewed at 0.25% in year 2 through 10 in this contract. I'm not saying that's going to happen, but it could if the company wanted to. You'll see the initial index interest rate cap of 4.1%. So that 4.1% is the maximum you can earn. Well, what is the minimum cap? 2%. So they can actually, after that 4%, let's say the first year is due, they can renew it at 2%. So even if the index went up 15%, you could be earning 2, which is less than fixed account rates. So another option you'll see here on the bottom, the S&P 500, which is a popular index, obviously. The initial specified rate was 7.75. Minimum in the contract is 1%. So you notice what a big difference is between the minimum they can actually renew it at and actually what they start out offering you when the product is sold. This is what I call risk, because you don't know what the company can do. A few things you can do. There are a few companies in the industry that'll let you lock in the participation rate for the entire term of the index annuity. So an example, there's a product right now that has a 7-year term tied to the S&P 500 where the cap, I believe, is 7 to 7.5%, and it's locked in for the entire 7-year period, right? So that's the cap is locked for the entire 7 years. This actually would remove the renewal rate risk from the equation. Now, you still have the risk of the index going up. So really, to buy an index annuity, you need to believe that the index is going to perform well and the company's not going to screw you over, or that you find a solution like this where the rates are locked in for the duration for the index annuity. Also, some companies will actually publish their renewal rate history. So this is helpful because that way it's an idea that if they're publishing this on a regular basis, they're probably proud of it and they probably will perform better than companies that won't. Another solution or recommendation is to focus on very established companies not backed by private equity. Well, one thing they could do with an insurance company, as I just noticed you on these the renewal rates, is if they wanted to increase their profitability, just lower to the floor or lower significantly all the renewal rates on all of these products, and they could do it in the contract. So these are a few solutions for you. Now, in terms of what to look out for in the contract, what type of annuity is it? Is it qualified or non-qualified? If it's a MYGA, what is the guaranteed rate? How long is it guaranteed for? What's the minimum, renewal rate for the index annuity for the option that you've chosen? What are the fees? How long are you committing your money for? What type of withdrawal options do you have available? How much can you take out penalty free? The nice thing is if you go to our website, annuityresources.com, and click on the reviews or the rates tab, I'm a big believer in full transparency. Our website will provide all the surrender charge schedules for many products in the industry. So if you're curious, it's a great resource to check out. Whether the product has a market value adjustment, the market value adjustment can be either a charge or it can be either a good or a bad thing, depending on the difference in interest rates between when you buy the annuity and actually when you take the money out. And it goes away at maturity, just so you know. What type of riders and fees are there available? If you get a bonus, what's the fine print on the bonus? Companies do not have large buildings because they give away money for free. If you're looking at a bonus annuity, you want to look at all the fine print surrounding that bonus. What type of nursing home, terminal illness, hardship waivers are there attached to the product? Is it RMD friendly? So for example, if you have to take RMD distributions from your IRA, then finding one, I'll typically recommend a product that's either RMD friendly or that allows for at least 10% withdrawals. What happens after the annuity matures? Does it automatically renew? And then last but not least, is there a surrender charge at death? Some of the annuities, if one of the owners passes away, they will charge a surrender charge at death. So this is something that you want to look out for. Mistake number 2 is trusting what is said instead of what is written. Now, a lot of times annuity mistakes stem from sales language that sounds helpful but omits key details. I don't think a lot of people in the industry are bad, but I do know that there are a lot of details that can be missing from a sales presentation that are important and could influence your decision. One of the reasons I create these videos. The annuity contract is the truth. This is what you're going to be held to after you buy the annuity. The sales pitch and everything that's told you is marketing. The contract is the truth. So you really need to be aware of what the contractual reality of what you're buying is, because that's what you're going to be held accountable to. I mentioned that you can ask your company to send you the specimen contract for the annuity they're trying to sell you, right? Another idea would be, if you don't believe me, then go upload this specimen contract into ChatGPT and then just see what ChatGPT thinks about what a realistic rate of return is on the product. It can also be helpful to find some of the negative parts of the contract as well. But I would always ask for the contract, especially if you're buying an index or variable annuity. It's very important to know the fine print. For MYGA annuities and for income annuities, they're relatively straightforward because, the rate's going to be locked in for the entire term for the MYGA, and the income amount's going to be locked in after you buy the SPIA. So there's not a big difference normally. And these are the products that we really focus on, MYGAs and then SPIAs and DIAs. But if you buy an index or variable annuity, I would encourage you to look at the contract before you sign the dotted line. Third mistake is not being aware of the bad stuff. Again, the surrender charges, market value adjustments, those are the first two. Third is volatility controlled index gains. So with index annuities, sometimes they might promise you this massive return. So, we're going to give you 300% of this index. Well, what they don't tell you is that it's a volatility controlled index, which might only move, maybe it only goes up 300% of one is 3%. So I would be careful. A lot of the marketing behind products and even the products, how they're designed to make them easier to buy and easier to sell. Doesn't mean they're going to be necessarily good to purchase. That's another thing that I would look out for. The renewal rate history, which we've already discussed, the fees, customer service, and how do they answer the phone easily? This really varies based on some of the companies. Last but not least, misleading board-on dates. Insurance companies know that no one wants to buy a product from a brand new insurance company. So what do? Well, they buy shell corporations. Now, let's say you and I, we want to go start an insurance company next month, right? What would we do? We would buy a shell corporation, and then we would operate under the shell corporation and then tell people that we've been operating since 1930 in our marketing. Now, it's misleading because the company's only been around since a month, but the marketing says it's been around since 1930. And this happens all the time. So I would be aware of how long the carrier and the company has been operating under the current name, just to give you an idea of how long they've been functional with that name, and also just period is also helpful. Fourth mistake is having, as hypothetical illustrations and having realistic expectations. Every proposal you're going to get looks good on paper. One thing that's really important that I mentioned earlier is that proposal engines for index annuities do not consider renewal rates, right? So they don't factor them in. The proposal could show this back tested at 8% return or 9% or 7% or whatever it is. Well, if it doesn't include the renewal rate changes, what good is it? It's toilet paper, in my opinion. It's worth nothing because it doesn't accurately show you. It shows you what the index performed at, but it doesn't show you the other important part of the contract, which is the renewal rate history of the company. I'm sick of getting calls of people that have purchased an annuity 7 years ago. And I'll give you an example. I have a client that I really like that lives in Hawaii, and she came to me a year and a half ago. She had bought 2 annuities. They were both index annuities. One of them she purchased, I think, in 2009. I'm not going to mention the company in case they're watching this video, but she bought an index annuity. It was an A+ rated carrier. They've had a good reputation. They've been A+ rated for 50 years. She basically averaged since 2009, her index annuity, about 1%. 1%. She's so pissed off. She bought these 2 products. She's averaged 1%. She loves the product she's purchased from us because they're contractually guaranteed at 4 and 5% since rates have been higher. But she was stuck earning 1% for all that time. I'm sure she doesn't remember doing a lot of research when she bought that product, but she's happy with what she has now. We'll just keep it at that. But I don't like getting these calls because people are promised some huge return. They don't get them. I always try to give realistic expectations. What's a realistic expectation for index annuity? You could earn 1 to 5 or 6% realistically. Now, what I think that people dramatically underestimate is the odds of them getting a 1 to 3% return. Another reason this is very important is that the stock market, when this video is being filmed, is very expensive. If you look at the price to earnings ratio, price to sales ratio, price to book ratio, Buffett ratio, if you look at any ratio, it's historically off the charts, one of the most expensive stock markets in history. Most people that call me probably earned 1 to 3 or 4% in their index annuity, is what I would tell you. The reason we don't currently sell them now is that you can guarantee 4 or 5%, and that's a bigger number than 1 to 3, which I think is a likely scenario of where they're going to earn, especially when you factor in the stock market valuation, because if you have to deal with the renewal rate possibility, and then on top of that, you don't earn dividends for index annuities, and then on top of that, the indexes are at very high levels, then you can see how earning a low return is very likely now. So it's very possible. Fifth mistake is not shopping around or shopping around too much. Now, I'm going to show you how to find some of the best returns now by going to our website, annuityresources.com. This is our homepage. If you click on rates on the very top here, you'll see our rates page here. Now, what you do is we have around 40 companies on our platform. You can see the list here. All the companies we work with is around 40. What you're able to do with our platform is enter in your state, the rating that you have, the term, the investment amount. And what it does is it automatically, what the rate information, everything that's shown you is automatic. So let's just pick what we're in California. We're looking for a 5-year product. We have $150,000 to invest. What it automatically will do is it'll show you only products that are for sale in California. Now, annuities are state regulated, so the rates, the products that are available, everything is depending on where you live. So what it's done here is you can see SPLI as of today currently has the best rate. They're A-rated carrier. Equitrust, let me see. Let me go into, let's do A or higher. So now you can see here it's restricted. A-rated companies are better in California, and then with $150,000. So it shows you what the rate is. It shows you how much earnings we'll earn. If you wanted to get more information, let's say a national life group, you click on details, and you notice what it will do is it'll give you all the more details. It'll show you the surrender charge schedule. You can download the company brochure. We reveal the agent commission and how much our company makes if you buy it. It'll show you the free look period. It'll show you what happens at death. So whether they charge a surrender charge at death or not. On the top, it'll show you some of the writer information. You can get a link to their website. We have a list of what we like and what we don't like, as well as, let's see, you can see the rate lock period for transfers and for after-tax money, the states that are available, and also the rate banding, right? Because the amount of money that you give a company will dictate. So in this product, they have a separate rate for 100,000 to $1 million, and then one that's lower for under 100,000. You can complete our online application, and we try to make it as easy as possible for you to go through. But a lot of people, what's important is you're able to shop everything that's available in the marketplace, all 40 companies. Most companies in the industry offer a fraction of the companies that we do, right? So it's very important to shop around, because when you shop around, you're going to get better deals. It's really that simple. Now, if you look at like Chase, Fidelity, Schwab, some of the bigger firms, like I know Chase Bank sells, like for traditional MYGA annuities, the last time I asked them, they told me they had 2 or 3 products. So they have 2 or 3 products and we have 40. Where do you think you're going to get a better deal? Fidelity and Schwab typically have less than 5 or 10 products that are available. We have 40. So 6th mistake is buying an unstable company just because it's covered by the state guarantee fund. Now, I get calls where people will go dumpster diving for unstable companies because they get an extra 0.5%. There's a few important things. Now, as agents, we're not supposed to mention this, but I wanted to at least highlight why you should not just blindly buy a company. There are these state guarantee funds in different states that are set up in every state across the country. The state is not involved in the guarantee fund. Basically, the way that it works is that it's a pot of money that the larger companies typically put money into So like I live in Texas, every company operating within Texas has to put money into a pot, right? And the larger companies put in proportionally more than the smaller companies. It depends on the larger companies basically being able to bail out the smaller ones. There's not enough money in this pot to cover everything. So normally what happens in the industry is that annuities are safe in general. The primary guarantee is the claims paying ability of the insurance company itself, right? So you want to be careful. Also, if you're looking at a lower rated company, I would make sure that they're covered by the state guarantee fund. Not all of them are. So that's something else that you can verify and check. Personally, I own 2 MYGA annuities. They're both from A+ rated carriers. Just to give you guys an idea. When I bought the annuities, I could have easily earned a higher rate of 30, 40, 50 basis points if I went with a much lower rated company. But I said, you know what? I don't have to worry about it. For me, it's well worth the money. I'm still getting one of the very best products in the market for the rating. In terms of ratings, just to give a general idea, an A+ from AM Best, this is a general guideline. An A+ rated carrier is roughly the top 10% of the industry. An A-rated carrier is roughly the top 30%. An A- rated carrier is maybe the top 50, 45 to 60%. And then B+ is the bottom 40 to 50% of the industry. So B+ and then below. So it kind of gives you an idea. So if you're conservative, I recommend an A-rated carrier above. That's the top 30%. And if you want to avoid problems, an A+ rated carrier is in the top 10%. And also think about the total, what percentage of your assets are you putting into the company as well? Some of my clients are higher net worth individuals and they're putting in 5 or 10% of their assets and they might not mind as much. But if you're putting in, 30, 40, 50, 60% of your assets into one product, obviously you want to be more careful. The last mistake is focusing on a number that's sold to you or focusing on a number just in general. Now, it can be confusing. You can see bonuses, you can see income roll-up rates, you can see a fixed rate. What you really need to be clear on is, what does that number do for you? Is it growing your accumulated value? Is it growing an income roll-up rate? Is it a bonus that's tied to strings that when is that paid? What do you have to do to qualify for the bonus? What's the vesting schedule on the bonus? Don't buy based on a single advertised rate only to find out that, like in an income roll-up rate, it's an imaginary value you can't withdraw, right? So understand what you're buying. Companies do not have large buildings. Insurance companies do not have large buildings because they are good at giving away money without making it up in other areas. They're going to take it away in another, and it only makes common sense, right? So be smart. Also, you can ask, if you're getting some type of bonus, if you're being offered something, ask whether the bonus, for example, is applied to your income account, your income base, or your actual account value. Your actual account value is the amount of money that if you wanted to move your account somewhere else, that's your actual account value. That's the important part. So there's something that's important to find out. Thank you for your time today. Again, feel free to visit our site to learn more, subscribe for more videos that we put out, and hope you have a wonderful day.